Joining me now for more on it, let's bring in Stephan Paternot. He's the co-founder and CEO of Slated.com, and Atish Davda is the founder and CEO of EquityZen. Welcome to you both. Atish, you know, the reference price is kind of set by the NYSE because you need some kind of benchmark, but you were saying in the private markets, the last trade was roughly where? It was a little over $30 to $31. It was around $31.50. So EquityZen operates in the private market. We help companies that are late-stage firms before an IPO get liquidity for their shareholders so that they can better control the timing of the IPO. We've seen trades for Slack and other companies that are of its own tier, large, private, well-known companies that are generating a ton of money, really, be pretty active in the private market. And is it true that Slack itself in the private markets had gone from like $10 a share to 30 just in the past year? Yeah, just about a year. We've seen, I believe in their S1, they said over $360 million. Of transactions took place just in the last year. Wow. And that gives you a lot of confidence when you decide to bypass the IPO route and go a direct listing route, because you say, all right, well, hundreds of millions of dollars have changed hands before. Right. So we know what we're talking about. It's not just a number I'm picking out of thin air. And Stephan, I mean, what do you think about this now following Spotify to become two high-profile, very large direct listings that have frankly gone off pretty well?
It's about damn time. I don't know, for those who can remember the Globe.com IPO, taken public by Bear Stearns, that was a quintessential example of a disaster where a stock is completely underpriced by the bank. The bank is ensuring that the stock blows up 1,000%, gets huge fees, that all the roadshow fat cats are going to get the flip out of the stock and make a huge profit. And who was left holding the bag? All the people who built the company and who invested early and took the risks. And so I've been against IPOs and saying that it's a very broken process now for decades, 2 decades. So the Spotify IPO followed by this IPO are very validating that there is a new approach. There's a better approach that limits the bank's fees, that limits what those fat cat roadshow folks are able to gain out of it, and actually lets the people who built the company and invested in the company early, have some sort of a pressure relief mechanism that's a little more controlled, right? They can start to get out. They don't have this 6-month lockup, and the price doesn't get as overhyped, as you guys pointed out. There's a much more clear correlation between supply and demand.